Alright, my history-loving friends, let's take a trip back in time right here in incredible India. Money hasn't always looked like the crisp notes and shiny coins we use today.
For a very, very long time, people use all sorts of different things as money.
Imagine this. In ancient India, some folks actually used grains, like big sacks of rice or wheat, and even cattle, like cows and goats, as money. Can you believe it? Imagine telling your friend, "Hey, I'll give you 2 bags of rice for that new kite," or trying to buy a bicycle by giving away 3 cows.
Counting your savings in how many bags of rice you had or how many cows were in your yard. It must have been quite confusing, right?
Later on, things got a bit more refined. Shiny metallic coins made of precious gold, gleaming silver, and sturdy copper became super common. This was a long phase, lasting for hundreds of years.
If you've ever visited a museum in India, you might have spotted some of these ancient treasures. We even had special punch market coins that are like 2,500 years old.
Then came the beautiful Gupt coins and even grand gold mohas from the time of the Emperor Akbar. Each coin tells a story of India's rich past.
Now, let's zoom back to today, my friend. What do we mainly use as money? Currency, which means our familiar paper notes and those handy metal coins.
But here's a cool difference. Unlike those old gold and silver coins, our modern currency isn't made of precious metals anymore. And unlike the grains or cattle people used way back when, a paper note on its own isn't useful, right? You can't eat a 500 rupee note or build a tree house with a 10 rupee coin. So why do we all accept it as money?
Here's the big secret. We accept it because our government says it's okay and it backs it up.
In India, the Reserve Bank of India, RBI, which is like the guardian of our money system, issues all the currency notes on behalf of our central government.
And guess what? No one else, no other person or company is allowed to print money. It's a very serious job.
What's more, Indian law makes it super clear. The Indian rupee is a legal way to make payments. This means that in India, absolutely nobody can legally refuse to accept Indian rupees when you're paying for things or settling a deal.
That's why the rupee is trusted and accepted by everyone, everywhere across India. When the government gives its stamp of approval and the law stands behind it, everyone trusts it and uses it without a second thought. It's like a promise from the whole country.
So friend, besides keeping money as cash in your wallet or piggy bank, where else do people keep their money? They keep it as deposits with banks.
Think about your parents or any working adult you know. When they get their salary at the beginning of the month, they usually have more cash than they need for their day-to-day expenses and wants.
So what do they do with this extra money? They smartly deposit it in a bank account. Banks are like super safe locker rooms for your money.
When you deposit money, the bank not only keeps it incredibly safe from being lost or stolen, but they also give you a little thank you gift.
They pay you a small extra amount of money called interest on your deposits. It's like your money is slowly growing little by little just by sitting in the bank. How cool is that? And here's another amazing thing about bank deposits. You can take your money out whenever you need it. So, if your parents need money for your school fees or a sudden family expense, they can just go to the bank or an ATM and withdraw it.
Because you can literally demand your money back on demand, these types of deposits are called demand deposits.
This feature makes demand deposits super useful and convenient for everyone. helping us manage our money easily. My friend, those demand deposits we just talked about have other amazing features. They let us make payments without actually touching any cash, all thanks to something called checks.
Imagine, Mr. Salim, the awesome shoe manufacturer we met earlier needs to pay his leather supplier. Instead of counting out a big stack of cash, Mr. Salim can simply write a check for the exact amount he needs to pay.
A check is like a special official note that tells Mr. Salim's bank, hey, please pay this much money from my account to the leather supplier.
The leather supplier then takes this magical piece of paper, the check, and deposits it into his own bank account. And then, like a secret handshake between banks, they work together to transfer the money digitally from Mr. Salim's account to the supplier's account.
See? All of this happens without even a single rupee note physically changing hands.
So, just like our paper notes and coins, these demand deposits, especially when they come with the cool facility of checks, are also considered money in our modern world.
Why? Because just like cash, they are widely accepted by everyone as a way to pay for things. Banks are like the real heroes here, because without them, we wouldn't have these super convenient demand deposits or check payments. And guess what? In today's super fast world, carrying big wads of cash is becoming less and less common. Thanks to amazing digital payment methods, paying is easier than ever.
It's clear that modern money, both the currency in your pocket and the money in your bank account, is very closely linked to how banks work their magic.
Two common ways to pay without physical money right here in India are, of course, through checks and also through awesome mobile payment apps like PhonePe and Google Pay that many of your parents might be using every day.
All right, my friend, we know banks keep our deposits safe and help us pay for things. But have you ever wondered what else they do with all that money people deposit?
Well, here's a super interesting secret. Banks don't actually keep all the deposited money in their vaults. They only keep a small part of it as cash.
For instance, in India, banks usually keep about 15% of the money they receive as deposits in cash.
Why only a small part? This small amount is like a ready cash counter, just in case some people come to withdraw their money on any given day.
Since it's very rare for everyone to come and take out all their money at the exact same time, this 15% is usually more than enough for the bank to handle daily withdrawals smoothly.
So, what happens to the major portion of the deposits? This is where banks do their loan business. They use this bigger amount of money to give loans to people who need money for all sorts of reasons.
There's always a huge demand for loans in our economy. People need money to kickstart a new business, buy a cozy home for their family, pay for higher education, or for countless other important purposes.
In this brilliant way, banks act like a super helpful bridge. They connect people who have extra money, that's us, the depositors, with people who urgently need money, that's the borrowers.
And how do banks make their own money? They charge a higher interest rate on the loans they give out than the small interest rate they pay us on our deposits.
The clever difference between these two interest rates is the main way banks earn their income.
So, when your parents deposit money in a bank, it doesn't just sit there gathering dust. It actually becomes an active part of our economy, helping others by becoming available as loans.
And the bank makes sure that everyone involved, from the person depositing the money to the person borrowing it, benefits in some amazing way.
We've talked a lot about money, right? But sometimes, my friends, people need to get money or even goods and services right now, even if they don't have the cash and they promise to pay for them later.
This clever arrangement is called credit or a loan. Credit is a super important part of how our economy works, almost like a trust system.
It's basically an agreement where one person, called the lender, gives something, it could be money, goods, or services, to another person, called the borrower, in return for a solid promise of future payment. Now let's look at two real-life examples to understand how this credit thing can work out in very different ways.
Example 1. Festival season and Salim's shoes.
Imagine it's almost Diwali and our hardworking Salim, the shoe manufacturer, gets a massive order for 3,000 pairs of shoes. They need to be delivered in just 1 month, which is super fast.
To make so many shoes quickly, Salim needs to hire more workers and buy a lot more raw materials, like leather.
So, where does Salim get the extra funds? He gets credit from 3 places.
First, he smartly asks his leather supplier to give him the leather now, and he promises to pay the supplier once he sells the shoes.
Second, he gets a cash loan from the big trader who ordered the shoes. It's like an advance payment for some of the shoes, with Salim promising to deliver the entire order on time.
Third, he secures a loan from a bank to cover additional production costs.
By the end of the month, Salim works super hard and successfully makes and delivers all 3,000 pairs of shoes. He makes a really good profit from the sale. And guess what? He happily uses part of that money to repay the loans he took.
See, in this case, credit was a huge help. It allowed Salim to meet his production goals, complete the big order on time, and even increase his earnings. So, here, credit played a positive and vital role in his success.
Example 2. Swapna's farming problem.
Now, let's look at a different situation. Meet Swapna, a small farmer who grows groundnuts on her 3 acres of land.
To buy good seeds, fertilizers, and other things needed for farming, she takes a loan from a local moneylender. She has high hopes that after her harvest, she'll sell her crops and easily repay the loan.
But in the middle of the season, disaster strikes. Her precious crops are attacked by nasty pests and completely fail.
Even though Swapna spends extra money trying to save them with expensive pesticide, it doesn't help much. Because her crop failed, she is unable to repay the moneylender, and the amount she owes keeps growing bigger and bigger over the year.
The next year, she has to take another fresh loan just to plant crops again. This time, her crop is good, but the money she earns is still not enough to pay back both the new loan and the old growing loan.
Poor Swapna gets caught in a very difficult situation called a debt trap. To repay just a part of her loan, she is forced to sell a portion of her valuable land.
In this sad situation, instead of helping Swapna, credit actually made her life much, much worse. Recovering from such a debt trap becomes incredibly difficult for her.
These 2 stories about Salim and Swapna show us something very important.
Whether credit is helpful or harmful depends a lot on the risks involved and whether there is any support or safety net available if something goes wrong, like a crop failure. My friend, every time someone takes a loan, it's not just a handshake and a promise. There's a proper agreement that spells out certain rules.
These rules are super important and are called the terms of credit. Let's learn some of these important terms.
First up is the interest rate. This is like a small extra rent that the borrower has to pay to the lender, on top of the original money they borrowed, which we call the principal. It's the cost of borrowing money. Next, sometimes lenders ask for collateral. This is like a security deposit or a guarantee for the loan. Collateral is something valuable that the borrower owns, like a piece of land, a house, a car or a scooter, some livestock like a cow, or even money saved up in a bank account.
The borrower gives this asset as a promise to the lender. If, for some reason, the borrower cannot repay the loan, the lender has the right to sell this collateral to get their money back. It's their safety net.
Then there's the documentation requirement. Before giving a loan, lenders often ask for certain papers or records.
This could be proof that you have a job, how much your salary is, or other identity papers. It's like proving you're a trustworthy borrower.
And finally, the mode of repayment. The agreement also clearly says how the loan will be paid back. For example, it might say you have to pay it back in small regular amounts called monthly installments over a certain period, like 2 years or 5 years.
Now, here's an interesting bit. These terms of credit can be very, very different. They change a lot depending on who is lending the money and who is borrowing it.
Why do lenders, especially banks, ask for collateral? They do this to make sure they don't lose their money. It helps them reduce their risk.
If the borrower genuinely can't pay back, selling the collateral helps the lender get their funds back. But think about this, my friends. What about people who are poor, who might not own any land or a big house or have much money in the bank? Do you think it would be easy for them to get loans that require valuable collateral? Sadly, no.
It makes it much harder for them to borrow money from formal places like banks because they don't have that safety net to offer.
So naturally, borrowers always look for loans with easy terms of credit. This usually means they want low interest rates, simple and flexible conditions for paying back the loan, and less collateral and paperwork needed. It's all about finding a fair and manageable deal.
Let's imagine we're going on a little field trip to a beautiful village in India called Sonpur. We want to see how different people there manage to get money when they need it, which means how they get credit.
Our first stop is Shyamal, a hardworking small farmer who has about 1.5 acres of land. Every farming season, he needs loans to buy seeds, fertilizers, and other things.
A few years ago, poor Shyamal used to borrow from the village moneylender. Can you believe the interest rate? It was 5% per month.
That's a massive 60% every single year. Just imagine how quickly the money he owed would grow.
But thankfully, for the last few years, Shyamal has been borrowing from an agricultural trader in the village, which is a bit better.
The interest rate here is lower at 3% per month. The trader gives him farm supplies inputs on credit at the start of the season, and Shyamal promises to pay him back when his crops are harvested and ready to sell.
Here's the catch though. Besides the interest, the trader also makes Shyamal promise to sell all his crop to him.
This is a smart move for the trader. He makes sure he gets his money back quickly, and he can also buy the crop at a cheaper price right after harvest and then sell it later for a bigger profit.
Next, we meet Arun, who is a bit more fortunate. He has 7 acres of land and is one of the lucky few in Sonpur who gets a loan directly from a bank for his farming needs.
His bank loan has a much lower interest rate, only 8.5% per year, and he gets a comfortable 3 years to repay it. Arun plans to repay after selling some of his harvest. Plus, he has a clever plan. He can store the rest of his potatoes in a cold storage facility and even get a fresh loan from the bank just by showing the receipt from the cold storage. The bank offers this special facility to farmers who already have crop loans with them. Arun is in a much better position.
Finally, we meet Rama, who works as an agricultural laborer in a nearby field. She doesn't own any land.
There are many months when Rama has no work, so she desperately needs credit to meet her daily expenses, like buying food or medicines. She also needs loans for unexpected things like a sudden illness in the family.
Rama depends entirely on her employer, a medium landowner in Sonpur, for credit. Guess what? This landowner charges a very, very high interest rate, just like the moneylender, 5% per month.
Rama repays by working for the landowner. Often, she has to take a new loan even before she has finished paying back the old one, trapping her in a cycle. She currently owes the landowner 5,000 rupees. It's a tough spot for Rama. Even though the landowner doesn't treat her very well, she continues to work for him because he's her only option for credit when she's truly in need.
Rama tells that for landless people in Sonpur, these landowner employers are usually the only ones willing to give loans.
So, after our visit to Sonpur, we've seen different sources of credit: traditional money lenders, agricultural traders, formal banks, and even employers.
And the reasons people need credit also vary a lot, from farming costs to daily needs and emergencies.
Most importantly, the terms of credit, especially the interest rates and how loans are repaid, are vastly different for a small farmer like Shyamal, a medium farmer like Arun, and a landless agricultural worker like Rama.
Arun is clearly in the best position because he gets a bank loan with a much lower interest rate and plenty of time to repay.
Not everyone in Sonpur can get cheap credit. Those who own land and can offer it as collateral are much more likely to get loans from banks.
Poor people like Rama, who have no assets to offer as collateral, are forced to depend on informal lenders, who often charge sky-high interest rates.
It's sad to think that because of the high interest and her constant need for money, Rama's debt will likely keep growing year after year.
There's another really important source of cheaper credit, especially in our villages and rural areas. They are called cooperative societies, or simply cooperatives.
Imagine a group of people who are facing similar challenges or have similar needs. In a cooperative, these people become members and they all decide to pool their resources together to help each other out in specific areas.
There can be different kinds of cooperatives, some for farmers, some for skilled weavers, or even for industrial workers. It's all about teamwork.
For example, there's a Krisha cooperative near Sonpur with 2,300 farmer members. The members deposit their savings with the cooperative.
Here's how it works. The members deposit their own savings with the cooperative. Now, using these deposits as collateral, the cooperative itself can then take out a large loan from a bank.
And with that big loan money, the cooperative then provides smaller, affordable loans to its own members for all sorts of useful purposes.
This could be for buying new farm equipment like a tractor, for their farming activities like seeds and fertilizers, for agricultural trade, for fishing, for building their houses, and even for other important daily expenses.
Once the members repay their loans to the cooperative gets the money back and can then give out even more loans to other members. It creates a wonderful cycle of mutual support. Alright, my friend, from the amazing stories we've heard about Shyamal, Arun, and Rama, we can see that there are two main types of loans in our world: formal sector loans and informal sector loans.
Formal sector loans are like the official organized sources. These are the loans you get from trusted places like banks, and the cooperative societies we just learned about. They follow proper rules and regulations.
On the other hand, informal sector loans come from less organized sources.
These are loans you might get from traditional money lenders, those traders like the one Shyamal borrowed from, your employers like Ramaj landowner, or even from relatives and friends. Did you know that in rural India, even as recently as 2019, while banks gave out the largest share of loans, moneylenders were still the second biggest source of credit?
This tells us that even though formal sources are super important, informal sources still play a very big role in people's lives in our villages.
Now, who keeps an eye on the formal lenders? That's the job of the Reserve Bank of India, RBI, which is like the big boss of all banks in India.
The RBI plays a super important role in making sure formal loans work properly. For example, the RBI makes sure that banks always keep a certain amount of cash ready from their deposits.
Banks also have to tell the RBI regularly how much money they are lending, who they are lending it to, and at what interest rates. Why does the RBI do all this?
It's to make sure that banks don't just lend money to big, rich businesses, but also to important people like small farmers, small industries, and other small borrowers who really need help.
But here's the tricky part. There's no organization that supervises the informal lenders. This means they can charge any interest rate they want, as high as they please. And sadly, there's no one to stop them if they use unfair or harsh ways to get their money back.
Compared to formal lenders, most informal lenders charge much higher interest rates on their loans. This means it costs the borrower a lot more money to take an informal loan.
Because the cost of borrowing is so high, a huge part of the borrower's hard-earned money just goes towards repaying the loan, leaving them with very little income for themselves.
Remember poor Shyamal, who had to pay 60% interest per year. That's a huge burden. And in some extreme cases, like Rama's, these sky-high interest rates can lead to increasing debt and even a scary debt trap, where you keep borrowing just to pay back old loans.
Even people who dream of starting a small business might get discouraged from borrowing because of these super high costs.
This is exactly why it's super important for our banks and cooperative societies to lend more money, especially in rural areas.
If they do this, it would mean lower interest rates for everyone. Lower interest rates mean people would have higher incomes left over, and they could borrow affordably for all sorts of needs, like farming, starting a small business, or setting up small-scale industries.
Having cheap and affordable credit is absolutely crucial for our country to develop and grow stronger. When we look at who takes loans from these formal and informal sources, we see some really interesting patterns, almost like a divide.
Think about poor households in our cities. A huge part of their loans, 84%, comes from informal sources. Now, compare that to rich urban households. Only a small part of their loans, just 17%, is from informal sources. Most of their money, a big 83%, comes from formal sources like banks. It's like the rich have better access to the official, cheaper way of borrowing.
We see a very similar situation in our villages too. Richer households there are able to get cheaper loans from formal lenders, while poorer households often have no choice but to rely on expensive informal borrowing.
This tells us something important. Formal sector credit from banks and cooperatives still only manages to meet about half of the total credit needs of people in rural areas.
The other half is still met by those informal, often more expensive sources. It clearly shows that richer people have much better access to formal credit, while the poor are sadly more dependent on informal lender.
Why is this happening? Well, there are a few reasons. Firstly, banks are not present in every single village across rural India. Even when a bank is there, getting a loan from it can be much more difficult than from an informal lender. Remember when we talked about needing documents and collateral for a house loan? Banks often require proper papers and some kind of security. The lack of collateral is a major reason why many poor people cannot get bank loans. Informal lenders, like the money lenders we saw, often know the borrowers personally. Because of this personal relationship, they are usually more willing to give loans without asking for collateral.
Sometimes borrowers can even get new loans from them without fully repaying old ones. However, as we've learned, these informal lenders often charge very high interest rates, sometimes don't keep proper records, and can even sometimes harass borrowers if they can't pay back. It's a risky and often unfair deal for the borrower.
In recent years, my friends, a really wonderful and innovative idea has emerged to help provide loans to poor people, especially in our villages.
It's all about organizing poor people, mostly women, into small groups called self-help groups, SHGs. These groups usually have about 15 to 20 members, all from the same neighborhood. They meet regularly, often every week, and the most important thing they do is pool their savings together.
Each member contributes a small amount, perhaps from 25 rupees to 100 rupees, or even more, depending on what they can afford to save. It's like a community piggy bank.
Once the group has some savings, its members can then take small loans from the group itself to meet their needs. The group does charge a small interest on these loans, but it is usually much less than what a harsh money lender would charge. This is a huge benefit.
Here's the really smart part. After a year or two, if the SHG saves regularly and manages its loans well, it becomes eligible to get a loan from a bank.
The bank loan is given in the name of the entire group, not just one person. This money is then used to help the members create their own ways to earn a living. We call this self-employment opportunities.
For example, members might take loans to get back land they had to mortgage, to buy good seeds and fertilizers for farming, or raw materials for their crafts.
For building or repairing their houses, or to buy important tools like sewing machines, hand looms, or even cattle for dairy farming.
Most of the important decisions about how the SHG saves and lends money are made by the group members themselves. They sit together and decide who gets a loan, what it's for, how much money, what interest rate to charge, and when it needs to be paid back.
The group is also collectively responsible for making sure that the loans are repaid properly. If one member struggles to repay, all the other members try to help resolve the issue very seriously.
Because of this group responsibility and collective effort, banks are often willing to lend money to poor women organized in SHGs, even if they don't have any individual collateral. This is a game changer.
So SHGs are brilliant. They help poor borrowers overcome the big problem of not having collateral, allowing them to get loans when they need them for various purposes and, most importantly, at a reasonable interest rate.
But there's an even bigger benefit. SHGs help women become financially independent and build their confidence. They also provide a fantastic platform for these women to meet, discuss, and take action on important social issues that affect their lives, like health, nutrition, and even domestic violence. It's a true empowerment movement. My friend, let me tell you about a truly inspiring success story, a real-life example of how providing loans to poor people at fair rates can change lives. This is the amazing tale of the Grameen Bank of Bangladesh.
It all began as a tiny project way back in the 1970s, but guess what? By 2018, it had grown into something incredible, helping over 9 million members in about 81,600 villages all across Bangladesh.
That's almost the entire population of some of our smaller Indian states. And here's the most beautiful part. Almost all of its borrowers are women, and they come from the poorest sections of society.
These strong women have proven to the world that they are super reliable when it comes to repaying loans. They've used these small loans to successfully start and run all sorts of small businesses, like making crafts, selling vegetables, or raising poultry, helping them earn a living and improve their families' lives.
Professor Muhammad Yunus, the brilliant founder of Grameen Bank, who even received the Nobel Prize for Peace in 2006 for his work, said something truly powerful. If credit can be made available to the poor people on terms and conditions that are appropriate and reasonable, these millions of small people with their millions of small pursuits can add up to create the biggest development wonder.
This line perfectly highlights the enormous potential that lies in simply giving small, affordable loans to those who need them most. It's like planting a tiny seed of hope that grows into a huge tree of development.
So, my friend, we know about money and credit. We started from the simple act of buying a toffee to the larger issues of loans and development.
We looked at the history of money in India, from early forms like grains and cattle to the modern currency issued by the Reserve Bank of India.
Always remember, money makes our daily exchanges super easy, like a common language for trade. And credit, or borrowing, can be a really powerful tool if it's used wisely and responsibly.
It's so important to understand the different ways we use money, how our banks and other lenders operate, and how credit can either help us soar to success or sometimes lead to difficulties.
By learning about all these things today, you're not just becoming smarter, you're becoming better prepared to understand the economy all around you and make really smart decisions in your own lives as you grow up.
Ultimately, the big goal for our country is to build a financial system where absolutely everyone, whether they are rich or poor, has access to affordable credit.
Because when everyone has a fair chance to borrow for their dreams, to start a business, to get an education, or to build a home, it can truly help build a brighter and better future for all of India.
Got any questions? Ask in the comments below. We are here to help. Subscribe for more. And let's keep learning together. That's a wrap. Now go out there and amaze the world with what you've learned. See you in the next one.